U.S. nat gas futures experienced a slight downturn on Tuesday, finding it difficult to surpass the significant resistance level at $2.25. This decline came after a notable rally in the previous session, where renewed buying interest appeared as prices approached the $2.10 support level. The market's recent fluctuations are largely driven by a mix of weather patterns and technical chart indicators, including a potentially bullish reversal pattern identified earlier this month. In early Tuesday trading, nat gas futures edged up slightly, gaining a few cents as traders assessed the mixed signals from the latest weather forecasts and production figures. The most recent projections indicate moderate national demand through Friday, with an expected surge in demand over the weekend due to an unusually hot weather system across much of the United States. However, this is countered by cooler conditions in the north and east, likely dampening overall demand and creating a complicated market environment. Despite these weather-related influences, the nat gas market remains under pressure from an ongoing oversupply issue, which continues to exert downward force on prices. Major producers, including EQT and Coterra Energy, have responded to persistently low prices by cutting back on production, delaying new drilling projects, and postponing well connections to pipelines. These production cutbacks underscore the severity of the price slump, which has rarely been seen at such low levels during peak summer demand. I anticipate the effects of these cutbacks will become evident between October and November. Production in the lower 48 states has experienced a noticeable drop since peaking in July, with recent data showing output around 101 billion cubic feet per day, down from over 103 just last month. Market analysts have identified storage congestion risks as a key factor in the recent price decline, noting that these risks intensified as production surged in July. The market also faced additional pressure from a temporary reduction in liquefied natural gas exports due to Hurricane Beryl, though export levels have since rebounded to around 90%. In conclusion, while the short-term outlook suggests continued volatility, the market may see a more sustained recovery as export capacity increases and production better aligns with demand. The interaction between weather, production adjustments, and export capabilities will be crucial in determining the future path of nat gas prices in both the near and long term. Although natural gas futures are trending downward, the market remains well supported by the previous high at $2.15 and the short-term pivot point at $2.10. On Monday, the market successfully defended the $2.10 pivot following the weekly closing price reversal bottom, indicating that buyers entered during the dip. However, there has been some reluctance among buyers to confirm the upward move, with a breakout above $2.27. If this breakout does happen, it would turn the trend bullish, setting the stage for the market to test the downward sloping 200-day moving average at $2.40. Should prices fail to stay above $2.10, it could signal early signs of weakness and invite renewed selling pressure, though the chances of this happening are not high. Please like, subscribe, and comment to support the channel. See you in the next one.